I always tell people, kind of think about it like a lottery. If you want a $2 million lottery, do you want to wait 39 years to get your money, or you want your money now?
I like that. I like that example.
It's the same decision, except you're not taking a discounted cash flow by taking the money now. You're just accelerating the write-off sooner. And so now that depreciation expense is worth more now than it will be 10, 20 years from now.
Welcome back to the Stella Top Seller podcast, where we bring the strategies, insights, and conversations that help investors think bigger, build smarter, and create long-term wealth. I'm so happy to have in my studio Tom Brodie. Let me introduce you, Tom. Tom is specializing in engineering-based cost strategies, helping multifamily and commercial property owners unlock hidden cash flow, reduce tax liabilities, and scale their portfolios more strategically. Tom, welcome to my show.
Thank you very much. I appreciate it.
Well, I know a little bit about you, but my question is, after 27 years of your career at the Shell Oil, right,
Right,
into
right.
to this different industry of specializing commercial tax strategies, how did it happen? What's the biggest misconception that building that owners have when they come to that tax liabilities?
Well, the issue is that they just don't know. A lot of commercial property owners have started off small and kind of grown, and so their financial team is kind of grown with them. So a lot of times they outgrow their financial team, and so they don't know. CPAs should know about cost segregation and how they can maximize their clients' tax position, right, or minimize their client's tax position, but they're not sure about cost segregation.
Mhm.
A lot of times they just don't get a lot of training in it, and so they're hesitant to refer or even talk about it, and
Right.
so they just don't. And I mean, that usually when I find a building owner and I tell them about it, they're a little bit angry at their CPA, say, why haven't they told me about this before? And
Correct.
it's not their fault. It's almost like expecting your general practitioner to be able to perform brain surgery at a moment's notice. It's like you have to be specialized in this category.
Absolutely. And I see that a lot of investors assume that CPAs already handle everything,
Yeah.
but that misunderstanding that it could be costing them, I guess, a lot of money.
It really is. I mean, the whole thing about cost segregation is you're accelerating the depreciation write-off. It's within the tax code. You just have to know how to do it or find someone to know how to do it for you. And that's probably the preferred method. But it's just something that a lot of people don't talk about. And when I first heard about this through a friend of mine, he
Mhm.
said, you should look into this. And I did a little bit. And then I said, everybody's got to be doing this. This is one of those no-brainer activities that if anyone has commercial property, they're
Right.
going to know how to do this or they've heard about it. The reality is not many people do it. I mean, other than the people that own huge skyscrapers and things, but the smaller properties, a couple $1 million and below, have never heard of it. And so that's one of the things that CSSI is trying to do, is trying to
Mhm.
get the word out, just so people can take advantage of it.
So that's what we're doing. So
Exactly,
tell me,
exactly.
what's the power of this cost segregation? Meaning that for investors, let's say hearing this for the first time,
Yeah.
what exactly is based of the segregation on?
Well, what a cost segregation study does is it looks
Mhm.
at the building and breaks it up into faster depreciating categories.
Okay.
So the IRS lost a court case back in the late 90s that says not everything is a 39-year asset. So for a commercial building, it's a 39-year asset. For multifamily, it's 27 and a half. The
Mhm.
reality is not everything's going to depreciate at that rate, either 27 or 39. So they
Right.
came up into faster depreciating categories. There's a 5-year category, 7-year, 15-year, and then 39 or 27 for structural. Everything that's non-structural can be depreciated faster according to what bucket it falls in, if you will. That's
Right.
what cost segregation does, is divide up the asset into those buckets by
Mhm.
asset, right? Floor coverings, window coverings, cabinets, all of those things have a different asset life. So to correctly depreciate it, you should have a cost segregation study done so you'll know how to depreciate the asset we can do that, give that to you, and then you can take advantage of some of the new tax laws having to do with depreciation.
So it means if the investor already has their own properties, is it ever too late to benefit from that cost segregation study? Can you
Perhaps not.
explain maybe?
I said it depends, right? So if they've owned a building for like 15 or 20 years,
Okay.
yeah, probably, because it's probably have a lot of that already depreciated. But if it's something
Right.
that's been within the last 10 years, it's worth taking a look. And we offer a free estimate to say, okay, what happens and what the IRS lets you do is that you can look at what you should have depreciated under the accelerated method and what
Right.
you have, what's already on the books. That difference is what the IRS will let you depreciate or write off in the current tax year.
I
So you
see.
don't have to go back and amend the previous year's returns because nobody wants to do that. But the differential means you haven't missed anything. You're just going to record it instead of going back and recording in the previous years. That missed depreciation gets recorded in the current year, which is still a big benefit.
Of course.
The whole
Not
idea is that
everyone is.
right. And I always tell people, kind of think about it like a lottery. If you want a $2 million lottery, do you want to wait 39 years to get your money or you want your money now?
I like that. I like that example.
It's the same decision, except you're not taking a discounted cash flow by taking the money now. You're just accelerating the write-off
Right.
sooner. And so now that depreciation expense is worth more now than it will be 10, 20 years from now. And so that's why it's a big help to cash flow.
So, like you're saying, it's a lot of confusion around this bonus depreciation phase out. How are the current tax law changes affecting the investors today?
Well, the best thing that happened to this and to investors is the one big beautiful bill that passed in 2025, which brought back 100% bonus, because it
Okay.
had been phasing out under the old tax law. So anything that was built or purchased after January 20th of 2025 is now eligible for 100% bonus, which means all the assets that are not structural. So if it's in the 5-year bucket, the 7-year bucket, or the 15-year bucket, all of that can be written off 100% of that value
Right.
in the current tax year or whenever you're doing the study. So for someone that's just bought a property or is thinking about buying a property, this is great because they can write off a lot of that building, the non-structural piece of it right now.
So let me get that straight. You know what? I like what you said. So the most important, at what stage should investors start thinking about that cost segregation? Before acquisition, during the construction, or after the closing?
Well, we really can't perform the study until after closing, right? When they own the property, but we can do a preliminary estimate at any point. So if they've got properties, they've got 2 properties they're looking at and trying to make a decision, we can do an estimate on both the properties. And then that they can see, it's not the be all end all decision point, but just another piece of the information that they need to make the decision. So I would say before you buy a property, let's take a look. We'll run an estimate. Doesn't cost you anything, but you'll know how much you can benefit from the bonus depreciation.
Beautiful.
And if you've owned a property since the initial 100% bonus, which is from the end of 2017 to the end of 2022, even if you haven't filed for bonus depreciation, you can still do it. And we'll just look at the differential from what you should have taken versus what you could have taken or what you've already taken. And that differential can be recorded in the current tax year. So it's not too late. It's just if you've owned the property for like 15 or 20 years, there's probably not going to be much we can do for you. But if it's shorter than that, we should take a look, because who wants to pay more in taxes?
Of course, that's a great info. So, Tom, the way I see it, the smartest way, let's say the investors reinvest their tax saving and grow that portfolio, what would be your advice to that? I know that they wanted to do that, reinvest the tax saving and just, make that cash flow as well.
Absolutely. I mean, the amount of money we're talking about that you can free up in a cost segregation study is a down payment. I mean, if you're being able to get a depreciation deduction of a couple $100,000 or more, that's enough to put into your next property or, to put into renovating that property. So it's one of those things. And a lot of our clients just continually do this, right? So you can incorporate a cost segregation study with a 1031 exchange for your next property. And so when you get that next property, do a cost segregation on it, and you're deferring that tax liability even further, just further down the road.
Amazing, amazing. I wish all my clients would hear that, because there's certain things that, you know what, investors are focused only on the purchase price,
Mm-hmm.
or completely they even overlook of that tax advantages. So I want them to have
Well,
that
and
knowledge.
that's exactly, and I've been reaching out to a lot of realtors, kind of like yourself, saying, if they have properties that I see these listings, I say, hey,
Mhm.
have you ever thought about talking about cost segregation
Right.
to a prospective buyer? Because
Uh-huh.
if you can say, hey, you're going to buy this $10 million building, but what if it's only $9 million net? Because you're going to save $1 million in income tax deductions. It's things
Absolutely.
like that that a lot of realtors just don't talk about. And I think it's really a disservice to their clients, because if someone's buying property or trying to build a portfolio, they may have never heard of it.
Right.
So as a realtor, you can bring them, not saying you're going to do the study yourself, but you're
Right.
saying you need to think about this, because it's going to help you in the actual purchase price, because it's going to lower the effective total cost of that building.
Absolutely. And you have to know with who you're actually dealing with, who you're working. Especially, there's a lot of red flags when,
Yes.
should the property owners watch out when we're selecting that cost segregation provider. Because I
Well,
see sometimes investors, they can choose based on their cheapest price, but it can
yeah,
cost them much more.
that's getting the cheapest cost provider or lowest cost provider is probably not a good idea,
Right.
because this is the IRS after all, and you want to have someone that understands what they have to provide for documentation, and
Right.
then what the limits are. I mean, we've been around for 23 years now, and we understand exactly what the IRS is looking for,
Correct.
and you know we'll be the first ones to tell you, no, you can't do that, or we're not going to do that. But it's one of those things where if you're dealing with the cost segregation provider and they don't ask you a lot of questions about how you bought the property and what your plans are, then you need to find someone else, because there's a lot of strategy that goes into it, and we want to make
Right.
sure that you're making the right decision.
Absolutely. Listen, you know what? That's a great advice. You know what, Tom, you're so knowledgeable in this, what you do. What would be your best advice, I guess, to give to investors who wants to stop leaving money on the table? And what would you suggest?
Well, I would say, let's, rather than depending on your CPA to go find somebody as the building
Right.
owner, it's your money, right? And so one of our key lines is, it's your money, keep more of it. So what we'll say is, like, come to me, and we can actually run an estimate on your property, no cost, no obligation. Then once you see that, take that to your CPA and say, why shouldn't I do this? We don't know your tax situation, they do, but at the same time, once they see the amount of money that you're going to free up, they're going to say, yeah, let's do it. The biggest problem that CPAs have, or their biggest point of, I guess, caution, is that they're afraid they're going to have to support our work.
Mm-hmm.
That's not the case. We support our work 100%. So if there's ever any question, come to us and we'll answer it. So once the CPAs hear that, they go, yeah, okay, fine. As long as I don't have to defend this thing, great, let's go do it. And we give all of our work to the CPA and to the building owner, and we prepare our results so that the CPA can take it and easily bring it into the building owner's tax return. So
Mm-hmm.
once they understand that, and that we're going to do all the calculations and we'll defend it, then they're much more open to it. And they say, okay, yeah, this is something you should do.
That's a great advice. As I say, work as a team
Yeah,
together tightly with the CPAs as well.
absolutely.
The way I wanted to present this, real estate, it's not only about buying the right property, right? It's about to understand the strategies and
Mhm.
protect your multifamily wealth. So it's important to work with the right people like you. That's why I'm trying to introduce this knowledgeable, experience people to my clients. And this way we can save them a lot of money, a lot of headache, a lot of stress.
Absolutely. I mean, just on a kind of as a rule of thumb, we find that usually 25 to 30% of a building's value can be written off sooner. And
Mm,
it's things like that that people just don't realize. I mean, part of the misconception is that, well, yeah, there cost eggs out there, but it's not worthwhile. It absolutely is. I mean, a lot of times it's not the CPA's money. So they say, well, No, but the building owner says, I need the money now, right? So they're more keyed into the cash flow issue versus the long-term spreading of expenses.
Absolutely. Well, Tom, I feel that we have so much valuable information, and thank you so much for joining, at our podcast today and sharing that insights for our audience. And for every listener, I would like you to contact Tom. And if you look into scale your investment, this conversation may be saving you $100,000.
Yes.
And, Tom, if you wanted to share anything else, more than welcome. I'm so happy to have you on my podcast. And the way you are handling all these investments, it's amazing. It's amazing.
Well, I always tell people, I said, you don't know what you don't know until you ask, right? So if anyone has buildings out there they want to have us take a look at, like I said, we offer a free estimate. My phone number is 713. I'm in the Houston, Texas area. So my phone number is 713-906-3710. And we work nationwide anywhere. So that's one of the great things about, the media these days is we can jump on a Zoom call. And I talk to my customers and my clients all over via Zoom now. I mean, that's the one good thing that the pandemic brought us, is that people realize they can do this. And so this is something they can leverage and now reach out across state lines.
Amazing. You know what? You can leverage, you can speak directly to Tom. That's amazing. He's giving us that opportunity to have a free consultation on your biggest investment. You know what? Keep thinking bigger, investing smarter, and building the wealth strategically. That's what I always say to my audience.
Yes.
And I'm happy to have you. Looking forward to meet you personally. And thank you so much for all this information.
Great. Thank you for having me.
Thank you. Thank you, Tom. Thank you for listening to the Stella Top Seller podcast. If building real wealth through real estate is your goal, this is your show. Subscribe and follow me on social media. I'm Stella Shalamova. Keep thinking bigger, investing smarter, and living the top seller mindset. Until next time.